The USA is the biggest economy in the world. It has by far the strongest army of any nation, and accounts for roughly half of the world's entire stock market. But this seemingly impenetrable defence has a hidden weakness, one which is only now starting to be exploited. In his first year back, Trump has used this strength to bully not just America's traditional enemies, but most importantly, their long-standing allies. Europe, Japan, even Canada have all felt the weaponization of tariffs, all the way to real military threats against them. And up until now, there hasn't been much they can do about it. But that could all be changing.
China sold a record amount of stocks, $5.1 billion.
The bond market, and particularly US Treasuries, which were seen as a haven for so long, are no longer as safe.
Government bonds sold off dramatically.
There's a few countries over the last 5 years or so that have sold 100-year bonds.
The money moving around in the investments, this is stocks, bonds, corporate governments, derivatives, credit, you name it. You are going to see a crack in the bond market.
America is $38 trillion in debt, and now it's being used against them. Since 2021, China, formerly the world's biggest holder of US debt, has sold over $340 billion worth of US bonds. And it's not just them. America's long-standing allies are also trying to sell them too. And some European hedge funds have even gone as far as dumping all of their US equities in retaliation. For the last year, governments across the continent have been desperately scrambling to pump money into defense budgets. But what if their greatest weapon wasn't missiles or planes, but debt and equities? So, is selling US debt the only way to control Trump? And has the age of financial warfare finally begun? Before we look at how countries could weaponize debt, it's worth showing just how impactful this could actually be. Debt, treasuries, and bonds are terms that get thrown around a lot, but often without any real context. For nearly the last 100 years, the United States has been the bank of the world. Whenever they needed money, all they had to do was issue debt, and almost every major country around the world would be queuing to take it. Japan, China, and the United Kingdom all hold hundreds of billions of dollars of US debt, entrusting their savings to the US government. For them, this is kind of like an investment. The US government pays them on average 2% back every year, which compared to the return on US stocks may seem like nothing. But there is a difference. While companies may, and often do go bust, a country is far less likely to. People lend to the US because it's the ultimate safe haven, a place where money is almost guaranteed to come back. It's a reputation built thanks to decades of political stability, deep financial markets, and economic growth, something that took generations to build, but may be unraveling faster than anybody could have expected. The US government now owes a total of $38 trillion, roughly $110,000 for every single citizen of the US. For almost any other country, managing this level of debt would be completely impossible, but because the US is seen as the world's most trusted economy, investors were willing to lend at extremely low interest rates, as at the time there was basically no risk involved. That trust is what has allowed America to accumulate such enormous debts without the system breaking. But as America is starting to find out, all of this debt comes with some major risks. At current rates, the US government already spends around $1 trillion every year paying back interest to people who have lent them money. For context, that is more than their entire military budget. That means that even a small 0.1% rise in these treasury yield numbers translates into tens of billions of dollars, which the government would have to pay extra in maintaining the loan. Now, these markets are of course complicated, but there's a few things which cause this cost of borrowing to rise. At its core, the treasury market works like any other market: supply and demand. The US supplies more debt every year, and demand comes from whoever is willing to fund it. For decades, that demand has come from a small group of massive buyers: US institutions, the Federal Reserve, and crucially, foreign governments. But when those foreign buyers start stepping back, or worse, start selling, the balance shifts. When demand weakens, the US has to offer a higher yield to keep the money flowing, making the cost of all the debt go up. And if a country were to sell their debt, then this would also have the similar effect, pushing supply up. Okay, you may be wondering how this all links back to Trump's, shall we say, chaotic foreign policy. Since returning to office, Trump has lurched from one international crisis to the next. massive tariffs imposed on allies, threats against long-standing trade partners, the arrest of the Venezuelan president, and now a sudden fixation on taking control of Greenland and breaching Article 5 of NATO. And up until now, there has been very little the rest of the world has been able to do in response. European leaders have largely been reduced to carefully worded statements about monitoring the situation and calling for dialogue while avoiding any action that might escalate tensions further. This has left the world, and particularly Western developed nations, scrambling to find some way of imposing limits on behaviour they have no direct power to stop, which is where America's ballooning debt comes into play. Because while the US might have the strongest military in the world, its government's addiction to borrowing has left it dangerously exposed to what's becoming known as capital warfare. Of the $38 trillion that the US now owns, about 25% of it is held by foreign investors. Of that, the vast majority is held by a relatively small group of countries, primarily in Europe, East Asia, and Canada. And these happen to be exactly the countries that Trump has spent the last year antagonizing. Even for the world's largest and most powerful economy, it's a pretty risky position to put yourself in. US Treasury yields, which is the amount the US government needs to pay back in interest to people who have lent it money, has risen by 0.2% in the last few months. Now, that might not sound like a lot, but that shift alone is estimated to cost the government an extra $50 billion every year. And we are just beginning to see the earliest, most cautious signs of countries using this as leverage. A major Danish pension fund has announced its plans to divest its entire US Treasury holdings, worth around $100 million by the end of the month. Now, on its own, this really is just a drop in the ocean in a market worth tens of trillions of dollars, but it started to signal that we're closer to bigger players doing the same thing than you might expect. While China has sold nearly hundreds of billions in US debt, it's now also Western nations who are reconsidering. France and Germany have already repeatedly pushed for strengthening the euro's role as an alternative reserve currency, explicitly arguing that Europe should not be overly dependent on the US financial system. And Japan has now warned that US trade policy and sanctions risk destabilizing global capital markets and their investment in the US market. If even just one major holder of the US debt, like Canada or Japan, began aggressively selling, it would put an immediate strain on the market. Large volumes of debt hitting the market at once would force interest rates higher as the government tried to attract new buyers, but that would mean hundreds of billions of dollars in additional interest payments every year. It's hard to overstate just how serious this weakness is. Even without a foreign sell-off, US government interest payments are projected to climb to around $1.7 trillion a year by 2035, more than a third of what the federal government is currently raising in tax revenue. That alone will place enormous strain on public finances. But if foreign governments were also to start using their holdings of US debt as leverage, that already fragile situation would worsen quickly. And the consequences wouldn't stop at the doors of the US government. There's a very real risk that a shock like this could tip the entire US economy into a full-blown recession. Interest rates sit at the centre of almost every part of economic life, from credit cards and mortgages to major corporate borrowing. And while those rates aren't directly set by US Treasury yields, they are heavily influenced by them. When Treasury yields rise, they suddenly become a much more attractive investment, especially for domestic investors, so they end up selling other investments to move them into Treasuries, and that might end up helping the government, providing them with some much needed cash to continue funding their operations. But for everyone else, it means there is simply less money available elsewhere in the economy, pushing up the mortgage rates, student loan interest, and the cost of business loans. In many ways, this is an even bigger vulnerability than the US debt. Last year, US consumer debt hit a record high of $18 trillion, an increase of around 2.5 times since 2003. If interest rates were to rise sharply, it would trigger a cost of living squeeze, as larger and larger portions of people's paychecks were swallowed up just keeping up with repayments. Now, the idea that such a crisis could simply be inflicted on the US, not through an actual conflict, but through what is effectively moving numbers around on a computer, might seem a little far-fetched. After all, the US is by far the most dominant economy in the world, accounting for roughly a quarter of global economic output and around half of all global stock market value. At the same time, to maintain this system, the US is hugely reliant on the confidence and trust of other countries. The second that leaves, or worse, gets weaponized, the entire system would fall apart. And right now, Donald Trump is giving people every possible reason to do that. Nowhere is this clearer than with Greenland. What began as rhetoric quickly escalated into repeated suggestions that the United States might take control of the island by force. According to NATO terms, this would be considered an act of war, putting Europe in a previously unthinkable situation. Europe's initial response was framed in the language of hard power. Denmark moved to reinforce its presence in the Arctic, and NATO allies signalled their readiness to defend member territory if required. But confronting the US states militarily was never a realistic option. In a scenario where diplomatic pressure failed and military options were off the table, it's not difficult to imagine European governments looking instead to financial pressure, including their vast holdings of US debt, as a way of crippling the US without having to fire a single shot. At the same time, there would also be huge costs to Europe and the rest of the world if they were to do this. For starters, most US debt held by foreign countries is owned by private investors, meaning that to force a coordinated sell-off, governments would need to coerce domestic financial institutions, a use of state power unlike anything seen in generations, at least in the Western world. And even if a country were willing to cross that line, the problems don't just end there. Because starting an American debt crisis wouldn't just be costly for the United States, it would be catastrophically expensive for everyone involved. If a coalition of countries did agree to simultaneously sell US debt, they would need to sell the bonds at a massive discount, simply because there wouldn't be enough people to buy them at their regular prices. Investments that governments had made years back would be sold for big losses, costing them billions in the process. But the issues wouldn't end there. Banks, pension funds, and sovereign wealth funds all rely on US treasuries as collateral, simply because they are treated as the safest asset in the global financial system. They're used as a kind of universal guarantee, something lenders trust will still hold value tomorrow, no matter what happens today. But if the value of that collateral starts to fall, banks are suddenly asked to post more of it to secure the same loans. And if they can't, those loans end up being pulled, putting the banks themselves at risk of bankruptcy. It's the exact same mechanism that we saw during the 2008 crisis. What started as a financial market panic in the US quickly spread to the rest of the world. And the same dynamic would be at play if the world were ever to trigger a coordinated sell-off of US government bonds in an attempt to rein in the president. That shared dependence does admittedly make ever using this option in practice very unlikely, but the fact that it exists still matters. No matter how powerful a US president might be, if things ever went far enough, the rest of the world still does have a lever to pull. You could arguably see a glimpse of that reality when Trump quietly softened his position on Greenland at the World Economic Forum, a place where global political leaders meet with the heads of major banks, asset managers, and sovereign wealth funds. At this meeting, Ray Dalio, an investor worth billions, warned Trump of potential capital wars following his promise to invade Greenland, stating that his aggressive political direction could spark a new phase of global financial conflict. Not long after, Trump publicly clarified that he would not use military force to take control of the island, a significant walkback from his earlier stance. The whole saga reveals an important fact. The United States sits at the centre of the global financial system, not because it can compel the rest of the world to lend to it, but because for decades it has been as stable, predictable, and ultimately reliable. That perception is what allows the US government to borrow trillions of dollars at a relatively low interest rate, to run persistent budget deficits, and to finance what's become the largest military budget in human history. But that position is not guaranteed forever. It depends on confidence, and confidence can be eroded far more easily than it can be rebuilt. It's a subtle paradox at the heart of American politics. The same financial system that gives the US enormous power also makes it more vulnerable than it would care to admit. Now, you probably don't need me to tell you that the world is quite unstable right now, and that is making the price of one asset more than any other skyrocket. The world's biggest banks are turning aggressively bullish on gold. HSBC says gold could surge past $5,000 an ounce for the first half of 2026. JP Morgan is forecasting average prices above $5,000 by late 2026, with upside towards $5,400, and Goldman Sachs and Bank of America are both calling for $5,000 gold as well. At the same time, S&P Global Intelligence is warning of severe copper shortages. Silver has traded above $90 an ounce, making it the best performing asset of 2025. Gold, copper, and silver are all trading at or near all-time highs, and mining stocks are finally responding. The GDXU ETN is up more than 1,000% over the past 52 weeks. And that brings us to today's sponsor, Gold Mining Inc., ticker symbol GLDG, listed on the New York Stock Exchange American. Gold Mining is a gold exploration and development company with one of the largest resource stage portfolios in the Americas. It owns over 10 projects across Canada, the United States, Brazil, Colombia, and Peru, all established mining jurisdictions. Across these projects, Gold Mining reports an estimated 12.4 million gold equivalent ounces in the measured and indicated category, plus another 9.1 million ounces in inferred category. Roughly 81% of that exposure is gold, with the remainder primarily copper and silver. But Gold Mining doesn't just own mineral projects. It also holds meaningful equity stakes in 4 publicly traded mining companies, including Gold Royalty, US Gold Mining, Nev Gold, and Australian Mines. 2 of those holdings have seen explosive moves. Gold Royalty shares are up nearly 300% over the past year, and Nev Gold shares are up roughly 400%. As of mid-January 2026, Gold Mining's market capitalization is around $307 million, yet its 4 equity holdings are alone worth approximately $230 million at recent market prices. So in one of the strongest gold, silver, and copper bull markets in decades, Gold Mining offers exposure to both a diversified portfolio of mineral assets and a leveraged basket of publicly traded mining companies. Gold Mining is led by experienced industry veterans, including former Goldcorp CEO David Garofalo and serial mining entrepreneur Amir Adnani. Insiders own over 10 million shares, aligning management with shareholders. And if you're looking for leveraged exposure to gold and copper through a mining company with real assets, institutional backing, and multiple upside catalysts, Gold Mining Incorporate, ticker GLDG, is worth a closer look. As always, review Gold Mining's public filings, including its most recent annual information form and technical reports, available at cedarplus.ca.